5 minutes. That's the average length of a call that convinces a bank employee to hand over your account. Not a hacker breaking through a firewall, not malware sitting on your laptop. A phone call. Here's what that actually means for you. Every layer of encryption, every fraud algorithm, every risk model your bank runs gets bypassed the moment a human being on the other end of the line decides you sound like you. That's the two-word trigger for this video. Live breach. Not a data breach sitting in a file somewhere. A breach happening live, in real time, while a bank employee is on the phone with someone who isn't you. Let's build this from the inside out, because this attack doesn't touch your accounts directly. It touches the person authorized to open them for you. Think of Vishing as phishing's spoken cousin. Instead of a fake email tricking you into clicking a link, it's a live phone call tricking a human being into approving an action. The term for this is social engineering, manipulating a person's trust and judgment instead of breaking through a technical system. Banks train call center agents to verify identity before making changes to an account. That verification usually relies on caller ID, account PINs, security questions, and the caller's ability to describe recent transactions accurately. Every one of those checkpoints can be defeated with the right preparation. Caller ID spoofing is when someone falsifies the phone number displayed on the recipient's screen, making a call appear to come from your number even though it doesn't. Think of it like writing a fake return address on an envelope. The label says one thing, but the actual sender is someone else entirely. When your bank's system sees a call coming from what looks like your registered number, that call starts the conversation already carrying a layer of false trust. Some call centers use that matched number to automatically pull up your account file before the agent even says hello, which means the spoofed trust is baked in before a single verification question gets asked. In plain terms, the first checkpoint a bank relies on to confirm it's really you can be faked before the agent ever says hello. Here's the part they aren't telling you. The attacker doesn't need to guess your PIN or your security answers. They already have them, pulled from the same breach and broker pipeline we covered in the last video. Pretexting is the practice of inventing a believable scenario or identity to manipulate someone into revealing information or taking an action they normally wouldn't. A caller might claim to be you, traveling and locked out of the app, needing an urgent wire released before a deadline. Urgency is the tool. It compresses the agent's decision-making window and discourages the kind of careful, slow verification that would normally catch inconsistencies. Put simply, the attacker isn't hacking a system. They're managing a conversation, the same way a con artist manages a mark, using confidence, specificity, and pressure instead of code. Most people hear this term and move past it. Don't. Because the target of this entire operation is a real person doing their job under a call volume quota, not a machine that can be patched. Look at the numbers. Call centers are measured on average handle time, how quickly an agent resolves a call and moves to the next one. That performance metric, built for efficiency, creates an environment where a confident, well-prepared caller with real account details can move through verification faster than a nervous, legitimate customer who forgot their PIN. The incentive structure of the call center becomes an unintentional accomplice. Here is what that actually means for you. The same system designed to serve you quickly is the system an attacker exploits to move quickly through your defenses. Strip away the industry language, and here is what is actually happening structurally. Agent override authority is the internal permission level that allows a bank employee to bypass a failed automated verification step and manually approve an action based on their own judgment. That authority exists for legitimate reasons. A customer might fail an automated check because they moved, changed their name, or simply misremembered a detail. But that same override authority becomes the single point of failure when a convincing pretext is on the other end of the line. That's not a guess. That's how manual escalation paths are built into nearly every large call center's procedures. The data shows that once a human is empowered to override a system for good reasons, that same override can be triggered for bad ones. Here's the sequence worth understanding, because recognizing what happened is different from being told what to do about it. First, an unexpected notification of a completed transaction, password change, or account update you didn't initiate, often arriving after the fact rather than as a request for approval. Second, a total inability to reach your bank through normal channels immediately afterward, because the attacker may have added a temporary contact restriction or updated the primary phone number on file. Third, a wave of secondary account activity across linked services mirroring the same account recovery cascade covered in the SIM swap breakdown, because a compromised primary account often becomes the key to resetting everything connected to it. Fourth, a callback confirmation from your bank referencing a request you never made, which sometimes surfaces because a portion of the attacker's pretext left a discrepancy the automated system flagged after the fact. In plain terms, the pattern isn't a single suspicious transaction. It's a short, tight cluster of account changes that happened faster than any legitimate customer service interaction normally moves. That's not a guess. That's how the timeline of a live breach vishing attack is structurally different from routine account activity. From there, the drain isn't a separate event. It's the same call, extended. Once the agent approves one action based on false pretext, every subsequent request inherits that same false trust. Change the mailing address, request a new card, authorize a wire. Every step uses legitimate banking infrastructure exactly as it was built to function for a real customer in a real emergency. In plain terms, the account doesn't get emptied by force, it gets emptied by permission, granted by a real person who believed they were helping the actual account holder. Regulators have pushed back on this exact gap. The FFIEC's authentication guidance specifically calls out call center verification as a high-risk channel, pushing financial institutions toward layered verification methods instead of single-factor voice confirmation. That guidance exists because live breach attacks like this one were successful often enough to force a structural policy response. Some institutions have started layering voice biometrics and knowledge-based challenge questions that update dynamically, specifically because static PINs and security questions proved too easy to defeat with a prepared pretext. That shift itself confirms the mechanic, regulators, and banks both concluded the weak point wasn't the technology protecting the account, it was the single verification moment sitting at the front door of it. Here's what that actually means for you. The industry itself has already acknowledged, through its own regulatory guidance, that a 5-minute phone call was enough to move real money. That's the full arc: pretext, spoofed trust, agent override, cascading account changes, drain, and every link in that chain runs through a human decision point instead of a technical vulnerability. The mechanics here trace back to the same structural pattern as everything else on this channel. Institutions build systems that trust the previous verification step, and a live breach attack simply inserts false trust at the earliest possible point in that chain. That's the system. Not a technical failure, a conversation engineered from the first word that a real person on the other end of the line had no reason to doubt.